Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. In 2021, a lot of retail investors invested in ARK. They're dumping the ETF now, which is exactly what they should not have done. Okay, let me give you all an example of how dumb this is. In 2021, for $1,000, you could buy a limited edition iPhone. Fast forward to 2022, the same iPhone's price went down to $500. When do you think the best time to buy the iPhone is? Exactly. But see, the investors instead bought the phone for $1,000, selling it for half the price now. In ARK's holdings, not a lot has changed with the companies. So here's another concept analyzing in terms of the downturn. So the iPhone price went down to half. Now if the price went back to the original, that's a 100% price increase. On the way up, returns are always going to be much greater than the returns downward. Author of The Intelligent Investor and Warren Buffett's mentor, Benjamin Graham, stated that emotional and counterintuitive is what one would call short-term movements. Graham said that the market, when overly optimistic, is a sign for investors to exit their positions. When investors are being pessimistic, that's when they should actually purchase stocks. Not the simplest of formulae, and while further study is needed on that, still a concept worth keeping an eye on for any investor despite your knowledge and experience. That said, there is a chance Cathie could be wrong. Although if she is right, ARK investors are going to be flooded with money real soon. Do you think there's going to be a rebound on ARK Invest next year? Maybe leave your predictions on the comment section below. In some way, a majority believes that the impending rate increase will harm ARK Invest. However, Cathie believes that on the contrary, the only ones to be considerably hit by the interest rates increasing would be the big tech, adding that small companies can innovate and outgrow an interest rate increase. This was also mentioned as well by Social Capital CEO Chamath Palihapitiya, stating that a marginal interest rate increase could be outgrown by hyper-growth companies and would then in fact continue to survive in relation to big tech. Such outperformance would make sense. Let's say a company has a growth of 50% per year. A lower valuation interest rate of 2% with a compound interest power reduction wouldn't matter too much in the long-term success of the company. Meanwhile, a company with a yearly growth of 15% would be significantly hurt by an interest rate increase of 2%. Over 10 years, a company with a yearly growth of 50% with a 10% yearly discount would have 28 times the revenue growth. But with a 15% discount, you could only expect a 20-fold revenue growth. That's not a small difference. There is a way to calculate the time needed for a number to double, and that's with the rule of 72. Here it is stated that 72 divided by the rate of growth shows the years a number would need to effectively double. 15% yearly revenue growth of a company with a 10% discount will get us a company that grows by 5% yearly. So let's take that 72 divided by 5, we get 14.4 years. That will be the number of years needed for that company if it's sitting at a 10% discount. On another note, a company with a yearly revenue growth of 15% having a yearly discount on 12% would have a 3% yearly growth. Hence, it would take 24 years for that company to double its revenue. It would be horrible for investors if they needed almost 10 years to double. This shows the disproportion an interest rate could affect on bigger tech companies. The divergence between private and public valuation within companies is what Cathie believes she found. There would be an increase in private market valuations as a correction in valuation goes on in the public market, possibly since private investors understand that there wouldn't be much of a valuation impact from interest rates increasing. ARK is going to experience a very positive valuation readjustment. If Cathie is right about raising rates being unnecessary, contrary to what people think the Fed should do, it would be an insane opportunity to purchase innovative stocks if this month Fed raised rates by 50 basis points. Because the future would be looking bright for ARK Invest, since after all, rate increases wouldn't be needed in the future. Let's go back to the dot-com analogy. Month after month, value stock continues to rise. At a 5-year high, Ford stock is still trading despite the most recent sell-off. Over the past year, financials and energy stocks too have been rallying. Last year, the Vanguard Financials Index Fund was up 28%. Now the Vanguard Energy Fund is up 52%. For slow-growing stocks, increases like this obviously wouldn't be viable. This all points to a very large bubble for value stocks because of everyone's fear that the dot-com bubble could happen again. Here we can see Cathie showing the valuation and upward movement by Ford as an example for the value bubble. With ARKK, ARK's flagship ETF, now going down to $12 billion from its all-time high of a $27 billion peak, the tables have turned. ARK Invest is down by more than 50%, and with the considerable decline of prices, investors are nowhere near any of ARK's ETFs. A lot are even shorting them. However, this is a rather questionable reaction, since lower prices would mean higher expected returns in the future. Cathie Wood, ARK Invest CEO, shows how we're actually getting one of the biggest opportunities in stock market history, based on the price point alone. Many investors are drawing comparisons between ARK Invest and the dot-com bubble internet stocks. Although Cathie thinks the skeptics have no clue what they're talking about, because while our situation right now is quite like the dot-com bubble, there is a reversal of roles. Value stocks substantially crashed during the dot-com bubble, meanwhile internet stocks skyrocketed. Case on point, growth stocks, in relation with value stocks, recovered after the dot-com bubble. What you're seeing now is a graph that shows the Nasdaq returns along with Berkshire Hathaway back in 1999 to 2004. Berkshire's value consistently went up, whereas Nasdaq crashed considerably. This is where Cathie Wood sees the parallels, only with a role reversal. That being 2022's innovative stocks as the value stocks back in the dot-com bubble, and the 2022 value stocks being the internet stocks of 1999. You might think that's funny, but how the two funds perform is actually much alike. Over the last year, Berkshire Hathaway rose by 30%, whereas ARK went down by around 50%. It is quite interesting to analyze the patterns of price movements. However, there are cases in when something goes down, it would stay down. Nevertheless, a stage is being set for quite the rally in ARK Invest by the backdrop of macroeconomics. We all know that within this month of the year, the Federal Reserve is going to raise interest rates. A lot of economists think that within this month of March, there will be an occurrence of a rate hike by 25 basis points, otherwise a 0.25%. Although some actually believe that there is bound to be a higher rate hike, which might be by a 50 basis point rate hike, otherwise a 0.5% rate increase, according to traders pricing on a 30% chance. This is due to the most recent job report coming in a lot higher than expected. In January 2022, the US ended up with an additional 467,000 jobs instead of their expected 150,000. That's quite a significant difference and implies that there is a strong economy right now, also with unemployment rate staying rather low at 4%. That allows more leeway for raising rates as the economy is being quite robust according to Jerome Powell, a Fed chairman. Now there's a betting game amongst the economists and institutions where they're trying to one-up each other with higher and higher rate hike predictions. 7 rate hikes are predicted to come this 2022, according to the Bank of America. Quite the hot take from banks and economists, since a rate hike is usually around a basis point of 25 or 0.25%. Hence, a 25 times 7 would be a total of a 1.75% increase. As a sign of future pain to come, the Fed's statement was cited by the Bank of America. Already, money growth is slowing down while this is all happening. M2 money has already started to decelerate on a monthly basis. Convertible money, checking deposits, and cash being M2 money. ARK's valuations are already starting to price the fear of future rate increases and the coming rate increase this month. Growth stocks will be in a great position to rally as a response to these types of rate hikes if ever the inflation cools down. But to combat inflation, how many rate hikes is actually needed? Fear of the rate increase is exaggerated. That's what Cathie believes. At play are many economic factors that will influence the Fed's actions. So not many rate increases are going to be necessary to slow down the inflation. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.